Vertiv Holdings Co., trading under the ticker VRT on the New York Stock Exchange, is currently seeing a significant move in the market. At this moment, the stock is trading at $175.28 USD, which represents a substantial intraday increase of 13.32 points or 8.22% today. This surge is capturing the attention of anyone looking at investment options in the industrial and technology sectors. While many traders might be looking at the usual suspects like Apple stock or Nvidia stock for their portfolios, Vertiv is proving that the infrastructure supporting those tech giants is where the real action is happening today. This isn't just a random spike, it's a reaction to a major shift in how Wall Street is valuing the backbone of the digital economy. Most people looking at Vertiv see it as a simple cooling company, but the reality is far more complex and interesting. The common expectation is that the cooling market is a slow-growth, steady-state business. The reality we are seeing today is that Vertiv has become a primary beneficiary of the massive power and thermal demands of high-density computing. While retail investors might be using a simple Robinhood app or exploring various investing sites to find the next big winner, institutional players are moving into VRT because they realize that without the thermal management systems Vertiv provides, the advanced chips produced by companies like Nvidia simply cannot function at scale. Today's jump was largely triggered by a major upgrade from Barclays, which shifted its rating to overweight and hiked its price target to 200 USD. This move creates a curiosity loop for investors. Why now, and what does Barclays see that others might be missing? The answer lies in the massive gap between current capacity and the projected needs for 2026 and 2027. If you are managing your own individual brokerage account or using tools like Schwab Intelligent Portfolios, you've likely noticed that the broader market has been volatile lately. Many investors have been distracted by the daily swings of Tesla stock or looking for investment help with their Fidelity Wealth Management accounts. However, Vertiv has managed to separate itself from the pack. The expectation was that the massive run-up in data center stocks in 2024 and 2025 had already priced in all the growth. The reality is that the shift toward liquid cooling is happening faster than anyone anticipated. Barclays pointed out that the recent dip in VRT stock actually created an attractive entry point for those who missed the first wave. This is a classic case where the market narrative of a peaked cycle is being challenged by the hard data of order backlogs and margin expansion. Institutional activity in Vertiv has been intense. We are seeing major names like Norges Bank and Winslow Capital Management adding significantly to their positions. This isn't the kind of activity you see in a stock that has reached its ceiling. When you look at the Fidelity trading platform or use the Interactive Brokers platform to check institutional flow, you see a clear pattern of accumulation. These big players are looking at the possibility of Vertiv being added to the S&P 500 index in the first quarter of 2026. An inclusion like that would force a massive amount of buying from passive funds and ETFs. For someone practicing self-investing, this is a critical catalyst to watch. It's the difference between a stock that follows the market and one that leads it. The daily trading volume for Vertiv has spiked today, far exceeding its typical average. This suggests a high degree of conviction among buyers. While some might be worried about the valuation, with a P/E ratio sitting above 60, proponents argue that the earnings growth justifies the premium. In its most recent report, Vertiv delivered $1.24 in earnings per share, which was significantly higher than the $0.99 that analysts were expecting. Revenue was also up 29% year over year, reaching $2.68 billion USD. This kind of growth is what you typically expect from a software company, not a firm that manufactures physical cooling units and power distribution systems. This is why it's appearing on more and more online investing watch lists alongside high-growth tech names. Let's talk about the business model for a second, because it's important to understand why this company is so relevant right now. Vertiv specializes in the hardware and software that keeps data centers running. They handle everything from the power supply to the thermal management. In the past, air cooling was enough. You just blew cold air over the servers and called it a day. But as chips get more powerful, they generate more heat than air can carry away. This is where liquid cooling comes in. Vertiv is a leader in this niche, providing the pumps, cold plates, and manifolds that allow for much denser server configurations. If you're using Fidelity IRAs or a Robinhood cash management account to build long-term wealth, understanding these technical shifts is vital. Vertiv isn't just selling a product, they're selling the ability for big tech companies to actually use the hardware they're buying. The competition in this space is fierce, but Vertiv has a specialized focus that gives them an edge over broader industrial players. Companies like Schneider Electric and Eaton are also in the mix, but Vertiv is often seen as more agile when it comes to the specific needs of AI data centers. This specialization is why many people are looking at VRT as a way to invest online in the infrastructure side of the tech boom without the extreme volatility of the chip makers themselves. Even though the stock has had 48 moves of more than 5% in the last year, its long-term trajectory has been undeniably upward, outperforming many of the traditional tech darlings found on the Robinhood app or other investment platforms. Looking ahead, the catalysts for Vertiv are numerous, but so are the risks. The main catalyst is obviously the continued expansion of hyperscale data centers. As long as big tech companies continue to spend billions on infrastructure, Vertiv's order book should stay full. There is also the potential for margin expansion as they scale their liquid cooling production. On the risk side, we have to consider macroeconomic pressures. High interest rates can make the massive capital expenditures required for data centers more expensive, potentially leading to a slowdown in orders. There's also the question of whether the power grid can actually support all these new facilities. If the grid reaches capacity, it doesn't matter how good Vertiv's cooling systems are, the data centers can't be built. It is interesting to note how Vertiv is being treated by different types of investors. Those using SoFi active investing or Robinhood fractional shares might be more focused on the momentum and the AI play aspect. Meanwhile, those with Fidelity brokerage accounts or those working with Fidelity Wealth Management might be looking at the company's strong return on equity, which is currently over 50%. This dual appeal, both as a growth story and a fundamentally sound industrial firm, is what makes it so resilient. It fits into a variety of strategies, from aggressive growth portfolios to more balanced long-term views. Comment below how many shares of Vertiv Holdings Co. you currently hold, or if you're planning to wait for a deeper pullback before starting a position. Your perspective on whether these infrastructure stocks can maintain their current multiples is something I'd love to see. It's a great way for us to gauge the sentiment of the community. The stock's performance today is a clear signal that the market is beginning to price in a beat and raise year for 2026. Barclays isn't the only one raising their expectations. Goldman Sachs recently set a price target of $204, and Citi went even higher at $220. These aren't just guesses, they're based on the reality that the thermal management market is being completely reshaped by the needs of modern computing. While the general belief was that the infrastructure trade might be getting tired, the reality of the earnings power being shown by Vertiv is forcing a recalculation. Even if you're more comfortable with the Robinhood trading platform or the SoFi trading platform, the data coming from the Interactive Brokers platform and other professional tools shows that the smart money is still very much engaged here. One of the most impressive parts of the Vertiv story is their ability to manage their debt while growing so rapidly. Their debt-to-equity ratio is around 0.83, which is quite manageable for a company in a capital-intensive industry. They've also started paying a small dividend, which was recently raised to $0.0625 per quarter. While a 0.14% yield isn't going to attract the income-seeking crowd using Fidelity mutual funds for yield, it is a sign of financial maturity. It shows that the management is confident enough in their cash flow to start returning some of it to shareholders. This is the kind of detail that turns a speculative trade into a solid investment for those using SoFi investing or Schwab Intelligent Portfolios. We also need to look at the regional performance. Vertiv has seen massive growth in the Americas, with a 43% increase in that region alone. This is where most of the hyperscale activity is concentrated right now. However, they have faced some headwinds in the EMEA region, where margins have been a bit tighter due to competition and operational challenges. A key part of the 2026 story will be whether they can replicate their American success in Europe and Asia. If they can solve the margin issues in EMEA, there is even more room for the stock to run. This is the kind of nuance you need to consider when you are doing your own online investment research. The broader sector momentum for electrical equipment and parts has also been a tailwind. As the world moves toward more electrification and more digital infrastructure, companies like Vertiv, nVent Electric, and GE Vernova are all finding themselves in a sweet spot. But Vertiv's specific focus on the data center niche, which makes up about 80% of their revenue, gives them a purity that many competitors lack. For an investor using the Robinhood investment side of their app, this provides a direct way